Back in January, Nancy Pelosi filed an investment disclosure that nearly broke the internet. It revealed up to 69 million in reported transactions across Nvidia, Apple, Amazon, Alphabet, and other major technology names. Every finance channel rushed to cover it, and then they all moved on. But here's what nobody's talking about a few months down the line. How are the picks actually doing? Today, I'm grading Pelosi's 7 most recent picks against our quant model to figure out which ones are still worth buying at today's prices. Spoiler alert, a couple are even worth considering right now. Quick note before I get to them, investing carries risk. Nothing here is personalized investment advice, so do your own due diligence. All right. By the way, I'm Steve Reitmeister, but all my friends call me Righty. I spent nearly 20 years as the editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com, where our quant team built a 115-factor rating system designed to find the stocks most likely to beat the market. Before we dive in, a quick ask. If you want more stock breakdowns like this one, then hit that like button. It tells YouTube to send you more videos of this kind of content in the future. All right, now let's get on to those 7 Pelosi trades. Let's start with one of the positions that's actually working out quite well, and that being Alphabet with a symbol of GOOGL. Indeed, this is Pelosi's biggest winner so far. Note that throughout this video, I'm tracking each trade from the day she took the shares. So when I say she's up 20% on Google, I'm also answering the question that actually matters. Would you have made money if you bought alongside Pelosi? The upward price trajectory has been warranted. They've beaten Wall Street estimates for 13 quarters in a row, including a Q1 2026 report that came in nearly double what analysts expected. Our Zen Ratings quant model gives Alphabet an overall grade of B, which is a buy recommendation. Remember that our overall rating is the culmination of individual component grades in 7 key categories. This is where Alphabet does best. Top 13% for financials, top 8% for momentum, and top 2% for sentiment. One potential trade-off values what I would call a low C, landing in the lower 50% of all stocks we track. That's not an alarm bell, but this is a stock that has already run hard over the years, and thus further upside is going to require real earnings acceleration. But the strong financials and sentiment, along with their connection to many of technology's biggest growth trends, still makes Alphabet a compelling stock to watch. Please note that the Zen Ratings is updated daily, so for the most up-to-date ratings on this stock or any other, then be sure to visit the quote pages on WallStreetZen.com. It's totally free, along with lots of other valuable stock research. You can scan the QR code to go to the website now. Now we move on to another Pelosi pick in Nvidia, which is her biggest position. It was around $187 a day she exercised her options. During the week I'm recording, it's up roughly 15% from there. And it's up for good reason as one of the biggest beneficiaries of the surge in AI demand. This has translated into 109% earnings growth this past year, which is incredibly impressive for a company this size. Wall Street completely agrees with Pelosi's bullish assessment. The stock is a consensus strong buy, and street high estimates suggest the stock could see even more upside in the year ahead. Our quant model gives Nvidia a Zen rating of A, a strong buy recommendation. The component grades are mostly solid as well, with the standout being financial strength in the top 1% of all stocks reviewed. The one red flag to point out is that safety earns a D rating, currently sitting in the bottom 18% of all stocks tracked. That is pretty typical for the extra volatility found in most semiconductor stocks. But across the full picture, Pelosi seems to have timed this one right, especially as AI-fueled growth continues to drive up earnings expectations and the fair value of shares. Let's keep the party going with stock number 3 in Apple. I think you might have heard it before. I was trading for around $273 when she recently bought her call options. And on the week I'm recording, it's a little over 10% higher at this time. Now, Apple is a beloved tech giant that just keeps delivering growth. In fact, they've beaten earnings estimates for 13 quarters in a row, a similar streak to both Nvidia and Alphabet. Per our Zen Ratings model, Apple gets a Zen rating of C, which is a hold recommendation. But perhaps it is better to say C+, given that it currently ranks in the top 35% of all stocks analyzed across the 115 different fundamental factors. As we drill down into the component grades, Apple shows particular strength in financials, where it ranks in the top 2% of stocks tracked. Momentum is also an above-average B rating. But from there, things look fairly underwhelming. Apple earns modest C's for growth, safety, sentiment, value, and from our proprietary AI factor. Remember, C's are average, which isn't necessarily bad, but it greatly lowers the odds of future outperformance versus the higher A and B rated stocks. That's where the trade-off shows up. You got a cash-rich company with great financials, but Apple may not be growing fast enough or trading cheap enough to justify a buy at this time. A quick pause before we move on to the next stock. If you're getting value out of this kind of stock breakdown, then hit the subscribe button, notification bell. I do detailed breakdowns like this every week, and you don't want to miss what's coming next. All right, now on to stock number 4 with Amazon, which was $239 the day Pelosi exercised her options. And as I'm recording today, it's up roughly 10%. Now, just like Apple, the data is suggesting caution this time because Amazon's revenue and earnings growth forecasts lagged the industry by a significant margin. Plus, the stock has run hard over the years, leading to a premium valuation that lowers odds of future outperformance. Amazon is yet another Pelosi pick that gets a modest C grade from the Zen Ratings model. There are some impressive component grades in there, such as financials in the top 27% of stocks, but most impressive is the top 2% showing for sentiment out of the 4,600 stocks tracked in the Zen Ratings system. Those are real positives, but value again is a low C, sitting the bottom 30% of stocks tracked, which is a bad sign if you want to buy shares today. So let's call this a watch list pick, as a best perhaps buy on any significant dips that gets that valuation back on our side as buyers. Okay, let's keep this train going with stock number 4, Vistra, with a symbol of VST. They are one of the biggest independent power producers in the country, and these days power is another AI play given the increased demand from the data centers. The stock was around 164 days that she exercised her options, and as I'm recording, it's down about 10%. That big of a deal, but not that great either. Here's the part that should make Vistra shareholders and prospective investors uncomfortable. Vistra has missed Wall Street earnings estimates in 9 of the past 10 quarters. That's a non-starter in my book. It doesn't get any better with the Zen Ratings review of fundamentals in the bottom 34% of all stocks we track. At one time, this was an exciting growth story leading to a big rally in shares, but now the fundamentals appear to be softening, removing any reason to buy shares this time. Pelosi was early to this theme, but it's possible she held too long, and there's no reason to join her in this mistake. By the way, if you're interested in the best stocks to own now, then that's exactly what I share live every Monday at 7 p.m. Eastern Time. Not just what I'm buying, but how I'm finding it so you can do the same in the days ahead. I also unveil my trade of the week, combining the best of the Zen Ratings with my greater than 40 years of investing experience. All this and more awaits you on our next live training session this Monday at 7 p.m. Eastern Time. Sign up for free at wallstreetzen.com/live, or click the link in the description, or scan the QR code on your screen. I look forward to seeing you there. Now let's forge onward with stock number 6 in AllianceBernstein, the symbol of AB. She paid around $40 a share. As this week, it's down modestly. We're going to save some time here. There's absolutely nothing in the fundamentals that points to owning this stock. Instead, I'm going to share a better stock in the same industry based upon the Zen Ratings. I'm talking about Acadian Asset Management with the symbol of AAMI. Acadian manages around 120 billion client assets, and what makes them interesting is their methodology. They don't run discretionary funds where a portfolio manager picks stocks on intuition. They run quantitative systematic strategies. Their entire business is built on data-driven models that scan thousands of factors to find market-beating results. It's kind of similar to our idea of the Zen Ratings, but applied in a different context and for a different audience. Here's why that matters. For the last decade, big institutional investors, the pension funds and endowments that actually move the needle, have been firing their old school stock pickers and giving that money to quant shops instead. AllianceBernstein is on the wrong side of that trade. Acadian may be on the right side, judging by the current numbers. Revenue grew 70% over the past year, significantly above the industry average. Even better, this led to a 28% earnings beat in the first quarter of 2026. Signs point to even more earnings momentum ahead. The Zen rating on Acadian is elite A grade, which means a strong buy recommendation. All in all, we're talking about a stock in the top 3% of all that we analyze based upon the full 115 factor review. As we drill down to the component grades, they show strength in 4 key areas: financials, growth, momentum, and sentiment. This is a combination that typically spells future outperformance. Note that money management firms are typically outperformers during bull markets, as the rise in asset prices equates to higher revenue and profit. Right now, there's no reason to doubt the bull market is over, and little reason to doubt the attractiveness of Acadian shares. Let's bring it all home. I'm closing out Pelosi's list with what might be the worst stock for new investors. We're talking about Tempus AI with a symbol of TEM. But don't worry, because I'm using it as an example to serve up a real hero of a stock for you instead. Tempus is a healthcare technology technology company. They use AI and machine learning to analyze clinical and molecular data, mostly for cancer treatment decisions. This is Pelosi's worst performing pick by a wide margin, and for good reasons. The fundamental review marks it as a lowly D from the Zen Ratings, implying it's a firm sell recommendation. Pelosi got in early to see some nice gains on Tempus, but right now it's just a terrible choice for new investors. But I promise you a much better alternative in the same space, which is going to be Veracyte with a symbol of VCYT. The theme is the same, medical AI, but the fundamentals are completely different and completely better. Veracyte is a diagnostics company. They make genomics tests that help doctors diagnose and treat cancer. Their two flagship products help identify thyroid and prostate cancer patients earlier and more accurately than the standard testing. That's a real paid-for product used by real hospitals, generating real recurring revenue. This explains why Veracyte is a profitable business versus the whopping $300 million loss for Tempus AI. This is a great profit margin story as well at this stage, because they're turning 17% revenue growth into 160% earnings growth. That helped them print a stellar 58% earnings beat in the last quarter. This is not a fluke, as Veracyte has now beaten Wall Street estimates for 5 quarters in a row, every single beat at 29% or better. That typically points to more good times ahead. As you would expect, Veracyte enjoys a Zen rating of A, putting in the top 5% of all stocks reviewed. This includes strong component grades for growth, safety, and sentiment. This mix suggests strong business momentum, supportive institutional sentiment, and relatively stable fundamentals. The main risk to watch out for with this one is reimbursement policy. Veracyte's revenue depends on insurance companies paying for their tests, and any change to coverage rules can hit results pretty hard. That's the structural risk on any diagnostics business. But in Veracyte, you have an A-rated medical stock enjoying exceptional earnings growth thanks to their use of AI. Plus, they are riding a hot streak of 5 straight earnings beats that typically points to more beats ahead and more share price gains as well. This is the kind of stock Pelosi's Tempus AI bet was trying to find. The data just points somewhere else instead. Let's get back to the main theme, that being the scorecard for Pelosi's 2026 buy list at the halfway point of the year. It has its high points and it has its low points as well. Gladly, even with Pelosi's missteps, we can find other attractive stocks worthy of our attention. Now I want to hear from you guys. Which of Pelosi's picks are you most bullish on? Let me know down in the comment section below. Plus, what do you think of my replacement picks, dialing into those with higher Zen ratings? Now, if you want to find more great stocks with real future potential, then check out the video that's popping up on your screen now. In that one, I go through 6 high-growth stocks to buy and hold for the long haul.